What exactly are bonds? Bonds are debt that is issued by a group such as a government or a corporation. It is a way for them to borrow on the open market. It is essentially a loan, and they agree to make periodic interest payments, most often known as coupon payments. At the termination or maturity of the bond, they agree to pay back the principal amount that they borrowed, also known as the face value. So, how exactly do bonds work? If you want to purchase a bond, you go onto an exchange and you search for it, similar as you would for a stock. Once you purchase it, you are now the holder of that bond. You are entitled to any interest payments that the issuer of that bond may make. These are generally made on a semi-annual or annual basis, but differs by the bond. If you hold the bond to maturity, that issuer will pay you the face value or principal value that the bond was initially taken for. Maturities last anywhere from several months to several decades. If you wish to sell the bond before maturity, you are welcome to do so on the same exchange that you purchased the bond from. In terms of the risk and pricing of a bond, perhaps the largest risk is that interest rates change. Bonds are very interest rate sensitive. If rates go up, bond price will go down. This is because new bonds will now be issuing at higher rates, so your bond is less valuable. Now, if rates go down, the bond price will go up, which is the exact opposite. This is because your bond is now paying more than any new bond will, so it becomes more valuable. The next most likely risk is default risk, and this is the risk that the issuer of the bond does not pay you back or otherwise goes bankrupt. Additionally, there's another risk called call risk. That is an embedded feature in a bond where the issuer can decide to reissue the bond after a certain amount of time. They will generally compensate you for that, but we'll not discuss that today. In terms of pricing for a bond, there is a set formula for bond pricing because of their relation to price and interest rates. You can predict it. We will not cover that today, but we will cover it in another video. So why might you want to buy a bond as opposed to a stock or a different asset? Well, bonds have generally predictable returns, more so than other assets, because there is a known return. You know the interest rate that that bond is going to pay up front, and it's relatively guaranteed. Additionally, bondholders, specifically debt holders, generally have first dibs when it comes to repayment if a company fails or goes bankrupt. So you have a higher chance of getting your money back than, say, a stockholder. Additionally, bonds are relatively liquid. They might not be as liquid as stocks in certain scenarios, but they are much more liquid than most other alternative asset classes. So what are some other fixed income type products aside from the bonds that we've been talking about? Well, there are savings bonds. You might be familiar with these as maybe your parents or grandparents got you one when you were born. There are certificates of deposits or CDs offered by banks and other financial institutions. And then there are some alternative asset-backed securities. These include CDOs, CLOs, mortgage-backed securities such as CMOs or pass-throughs. These generally have a little bit more risk associated with them, but more return, and they vary greatly on a sliding scale from asset to asset. But these are all considered fixed income securities. So in summary, bonds have a stated return. You can choose your risk profile. They're relatively liquid. They're issued by different groups, including governments and corporations, and they have a known pricing formula. Additionally, there are other types of fixed income securities that have varying returns and varying risk profiles. Overall, fixed income securities should be included in your portfolio to properly diversify it and offer you different planning techniques and possibilities.